Thanks very much. Chuck just shared me something that is news to me. We are back. It is Tuesday morning, and you know what that means. Chuck Malamut, for the past 25 years, the official financial advisor to Hurley in the Morning, and the following program segment is presented by Chuck on a weekly basis here. Chuck is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck Malamut, top of the morning to you, my good friend.
Good morning, Harry.
How you doing?
How are you? I think I'll throw a disclaimer out here before we get started. If I had not given you an opportunity at the latter part of the week, prior to the Fed announcement, you would have definitely had a winner.
Here's what I would like to know. I changed it on the day of the meeting, which I shouldn't have done. But tell me she was not faking that that's the way they were going, and I'm going to prove that I'm right. I can accept it when I'm wrong, but I'm going to prove I'm right on the point because look what happened to the markets after they didn't raise the interest rate.
All right, so it's 8:06.
Yeah, I was wrong. I was Fonzie. I was wrong.
Let's mark that tape.
Chuck, he's fooling early. He's doing it.
Harry, you know.
But you put me on the spot. You should have let my prediction just stand. You put me on the spot.
I did.
I was multitasking on something else, and you texted me, what are they going to do? Because you wanted me. I think you wanted me to change. You didn't want me to be right, because I would have never brought that up had you not texted me. But I accept that I did change my vote. I was for it before I was against it. But I'm going to still say on the merit here, the merits of the case, the markets did not like the way the Fed handled this.
Look, Harry, if you take a look at what has been happening of late, and last week was a perfect example, there still is a lot of volatility in the markets, as evidenced again yesterday and this morning. As we wake up and we're looking at Dow futures down close to 200, so with really no reason today. I mean, there's been obviously the headlines on Volkswagen, but putting that aside for a second, that does not drive the equity markets.
By the way, isn't that an amazing scandal?
Oh, it's awful.
And I heard the chairman. I mean, I don't want to say I want to give him credit, but he unambiguously just came out and said, that
we erred, we're wrong.
Yeah,
and we have.
By the
to
way,
correct
they didn't error.
No, it was.
That was a bad act. For those who don't know, they put together equipment that actually tricked emissions tests. I mean, it's abominable. Actually,
I mean, this and when obviously that equity or that stock is under tremendous pressure, and that entire industry, including GM, Ford, Tesla. I mean, they are all, taking a hit somewhat as a result of what Volkswagen ended up doing or not doing, I guess. When
there's no reason for something like that, why do we stare at a sea of red in the Dow futures and all the different futures?
Harry, as I said a few minutes ago, the S&P year to date is basically down about 3% going into today. So if you tackle on today's numbers, and let's say that holds, and you're probably talking another 0.5 to 0.75%. But what has happened, the S&P remains in a and believe it or not, Harry, a pretty tight trading range. 1867 was the low that we put in back on August the 24th, and 2050 was basically the low end of the pre-correction range, as we'll call it. So, for the time being, we expect, again, a lot of volatility to persist as markets go through this healing process. We do expect to see some improvements, 3 to 6 month time horizon. 2016 earnings will start to check in, and we think those earnings should be about $128, based on the S&P. And the forward price earnings ratios should be close to 16 times earnings. So with that being said, the projections are that the S&P should trade again. This is from a technician standpoint. Over 2,000, 2,050, somewhere in that range. But what has happened, I mean, if you take a look at last week onto itself, Thursday and Friday, the announcement was made that, the markets after 2 o'clock on Thursday became very volatile.
Yeah. Straight down.
No. It actually didn't happen on Thursday.
Oh, I thought it did.
I mean, Thursday the market was sort of seesawing as to the direction.
Yeah, I stand corrected. I thought I vividly remember at the end of Thursday that the Dow was down hundreds of points.
No. At the end of the day, the markets were down, but as the announcement was coming, the markets were in somewhat positive territory, and I think what happened.
But they were waiting for the interest rate increase, and then when it didn't happen, this is my lay person's take on this, Chuck, and you tell me, because I said this in the 6 o'clock hour in advance of what you would say about it. The markets were up, and then they were waiting for what all the signals from Janet Yellen indicated would be probably that minimal low 25 basis point type interest rate increase to the benchmark interest rate, which would mean for the first time in almost a decade, we would not be at or near zero. And then she didn't do it. They didn't do it. But not just that. It was the reason they gave. She blamed the world. And then the markets did not like it, Chuck.
Harry, you're right. I mean, on Friday, the market,
8:11 and 35 seconds. Go.
The market on Friday, I mean, Thursday was basically at the end of the day sort of a down throwaway day. And you walked out and you thought, okay, the markets will be okay with this decision. And I think, all those that trade the market had an opportunity to really absorb this information on Thursday night. And you walked in on Friday, and Friday was just, as we all know, just a bad day in the markets. But all said and done, when you take a look at the activity for the week, basically unchanged. I mean, the S&P was down 0.1%. Equities had had gains early in the week, and then falling on Thursday and Friday after the Fed said they're going to hold the rates steady. So for the week, as you would expect, after that happened, your more of your dividend pay, bond type equivalent sectors like utilities, consumer staples, and healthcare they outperformed the market, while some other sectors, telecommunications, financials, came under a fair amount of pressure. Because remember, we've been talking about financials, particularly the bank stocks, looking for this rate increase because that helps them with their spread when they lend money, which ultimately creates higher profitability. So that did not happen. And now the question is, okay, as you mentioned a few minutes ago, the traditional reasons as to why the Fed makes moves one way or another did not happen. Mm-hmm. And
which I think guarantees that it will happen at the next meeting.
So, we had, again, the folks at Morgan Stanley were pretty dead set and stated that they thought if there would be no increase in September, it would probably happen.
But then late you went to 40%.
Well, no, that was me.
I
that
understand.
Was not,
Yeah,
I was about 20, and then as I'm hearing, like you're hearing,
she faked us out.
A lot of the data that was coming across, a lot of people believed that you would get that increase in September. So, typically the Fed focuses on the labor markets, as they had done in previous meetings, a lack of inflation, the strength of the dollar, global economic and financial issues as the reasons for their policy decisions. So, what happened was, because of this global growth issue, now the Fed wants to come to the rescue of other parts of the world. And as a result, the U.S. equities, suffer as a result of that. I mean, you think about it, Harry, we've had, like I said, tremendous volatility for the better part of the last several months, and we've gone virtually absolutely nowhere. I mean, if you try to trade this market, chances are you'll probably get whipsawed, and you'll walk away licking your wounds unless you're really, really good or you really understand what's going on. And you think about, a lot of the professionals got it wrong this time with the expectation of looking at that increase in September, which did not happen.
Very interesting. Do you agree with me that the way that Janet Yellen and the Fed handled last week almost ensures now that they have to raise interest rates at the next meeting? Because I didn't think, this is the irony of being wrong about this, I didn't think they should raise it at the last meeting based on how things were going, China and everywhere else. But I felt that they were going to at the end. Now I think almost she has to because of the reasons that she gave. Unless they're going to stick with this plan, though, that the world is too weak and it's contagion and all this, and not do it. But I think next meeting they do pull the trigger.
Well, Harry, in addition to the meeting, the Fed always has that opportunity if the information they receive works in the favor of a rate increase. They can come in virtually in October or November. They do not have to wait until December. And
I don't think they're going to wait till December.
And there are some technicians and professionals that believe that there's probably
maybe September. I've heard.
Well, we're in September.
Yeah, I mean next month, next time. Yeah.
You're talking about Okay, so
I'm talking about October.
And again, that idea of that eighth of a point instead of a quarter, that's now floating out there. So I think the problem is, the Fed is trying to do something that they really shouldn't be responsible for, and that is to, steer the markets. And I think the markets are kind of like a little, a child right now that's sort of throwing a temper tantrum.
Chuck, here's something I always thought was true, and then I heard a so-called expert say differently the other day, and now I'm sometimes when something you've always believed, you're told it's not true. I mean, as long as that's right, I'm always willing to to adjust. But I always thought if you raise that benchmark interest rate, that two things happen. One, the cost of borrowing money becomes more expensive, and your yield on savings gets higher. I always believed that those both were true statements. I heard some person say, if they raise the Fed rate, by 25 basis points, that doesn't mean that mortgage rates are going to go up. I thought they absolutely would go up.
Not necessarily so, and I think that everyone has baked in a 25 basis point increase, potentially one shortly after that. But once you get through that, the Fed's apparently going to sit back and wait and see what how the markets and how the economy reacts to that. But
I think that would be smart.
But that, excuse me, Harry, those rate increases actually affect more on the short end of the curve. Your short-term savers, your money in the bank, so to speak, in the savings accounts, checking with interest rates.
Well, wouldn't that be good?
Markets.
Wouldn't that be good then?
Well, it'd be great for savers, sure. I mean, it's been years.
So who would it be bad for?
What would happen is that if you're on the other side of that trade, if you have relatively short-term maturities,
I got you.
Chances are that they will they'll go underwater somewhat. But again, if you're holding a short-term maturity and you own, the physical instrument rather than a fund, then you should be okay. But
in a demand deposit account that bears interest, or a savings account, or a short-term, savings instrument, your yield would increase.
It should increase. I mean, it's been a long time since we've had rate increases, but typically that's what does happen. The longer end of the curve, which again, that 15, 30-year fixed rate mortgage, we don't seem to think that's going to make a big move in an upward direction. I think that'd probably be a real good question, for Brother Bill.
I was thinking about him.
To chime in with what he thinks. But
I thought he said before that would raise the interest rate if we were to increase the benchmark. So, Bill, if you're out there, and I know you are because you've been texting about your football prowess, because for 1 week you can do it, but wait, give me 2 weeks. In fact, give me 4 weeks, then he won't be texting that. Would love to get an answer on that, because if there isn't really, I mean, I did hear the downside, Chuck, that you said, because it would be richer on the other side of the transaction, but I just know we've never had a period in our lifetime where more than 9 years, going on a decade, at zero or near zero interest rate. It's unprecedented in American history. It
is, Harry. And if you take a look, what is happening at the price of the pump, you're seeing that not only here, but also, surrounding states. I had an opportunity to do some traveling this weekend with not one brother, but two brothers, as we visited upstate New York, our alma mater for Cornell University. It was interesting to see, Harry, that even in Pennsylvania and New York, that the price at the pump was significantly in check and lower than what we've seen, over the last year or so. So, I mean, gasoline as we know it, right now the national average is $2.38 a gallon versus $3.41 a year ago. And
look how in this area, I mean, even my corner store that's always higher than everywhere it seems on the planet is $2.02 as of today. Kirk Conover's been sending me things. I think they're below $1.90.
They are, and I've seen it. Harry, and in Pennsylvania, where it's imagine the Pennsylvania Turnpike. You're pushing. You would expect it to be significantly higher, and it's not. And in upstate New York,
could this ultimately, if we stay nice and low for the price of a gallon of gasoline, and the economy starts to kick in a little bit, we could have great discretionary spending activity.
Well, that's the problem, Harry, that we should, and I think what continues to happen until just recently, the consumer just didn't want to let loose, and now so what we're finally seeing now is that the numbers are starting to become a little more favorable, and I think that's what a lot of people got kind of upset with what the Fed did not do, because a lot of the data that was pointing here domestically seemed to be, pretty good information. For instance, like August retail sales, as we know them, were favorable. They looked to a stronger consumer spending. The increase was 0.2%. That fell a little bit short of expectations, but the 0.4%, which was attributed to core spending, was better than anticipated. So
0.4.
But strong retail sales should push real growth, as we know it, in consumer spending above 3% for the third quarter.
The official mortgage expert to the Hurley in the Morning program, the official mortgage professional for the Hurley in the Morning program, Bill Malamut, the Oracle has weighed into the Nostradamus of the airwaves, and the Oracle has sent me the following: I see no increase if Fed increases. So that is good news, and I trust Bill.
No, and that's what we basically, we're of the same opinion, that we don't think that rates are going to – I mean, rates move every day.
Yeah.
They haven't moved significantly.
But they wouldn't increase because of that action.
They're not going to move 25 basis points if the Fed makes a move with the overnight money.
So then rates will stay low. People can still buy, and that's very healthy. It creates, I think, some stability insofar as – I've always believed that this whole 7 years has been almost an aberration, where quantitative easing, 1, 2, 3, they're talking about 4 and 5, how this has kept things propped up in unnatural ways. It would be good to get back, in my estimation, into sort of solid principles, Chuck.
Harry, it should, and I think that when, to kind of shift back here as to why the Fed did not make the move, so to speak. We all are very, very familiar with what's happened in China, and they're now moving to a consumer-driven economy versus an industrial economy, and you can't flip the switch overnight. That takes years. Russia continues with a recession. We don't see that ending anytime soon. Brazil has significant, serious financial and political problems. We don't hear about that because the media doesn't want to focus on that. We've talked about international, particularly the Eurozone as we know it. That has been improving, but business confidence, is waning. And if you look at what's happening with the refugees over there, I mean, you have a very, very serious crisis that has to be dealt with. So, while our economy remains sound, all these overseas headwinds that we are hearing and witnessing and watching, could undermine the confidence levels that we have here domestically.
Chuck, 4 minutes before our bottom of the hour break, then we'll have one more power segment with Chuck Malamut, the official financial advisor to Hurley in the Morning, the Malamut Group at Morgan Stanley's Northfield office. Chuck is the managing director and the boss of his team, of course. And you can reach Chuck and the Malamut Group at 609-383-2010, 609-383-2010. That's 609-383-2010. You talk about geopolitical all the time over the past quarter of a century on your show, and you are smart to do so. You're absolutely correct in doing so because the geopolitical issues, you can't ignore them if you're being intellectually honest about our markets. And, Chuck, you never have. And I would just urge people to pay attention to what the presidential candidates are saying. And now in this age of technology, they don't even have to say it. They can tweet it in 20 or 30 characters, and they can actually affect markets. Biotech shares crumbled a little bit yesterday, tumbled at least is an accurate statement, after a presidential candidate tweeted something and that she'll fix it. I guess I've given her identity because it's, Carly, could have been Carly Fiorina too, but it wasn't. That she's going to fix all this, in other words, when she gets in. So, Chuck, what these people say can move markets, can't they?
Harry, it started with a drug that the manufacturer, the company, increased, I believe, in $7.50.
No, $13.50.
$13.50 a pill to $700
to $7.50,
and that sparked obviously this outrage, and
it looks like gouging.
It does, but
I'm not going to call it that. But it's a 53-year-old drug, and what's really kind of cruel about this is, why was it $13.50? It always was this drug for 53 years that if you get a certain type of deadly parasitic infection, you need this pill, and this is also used for patients with compromised immune systems. So all of a sudden, a 53-year-old drug is going to go from $13.50 per pill to $750 per pill. Something's, Chuck, I mean.
Well, putting that aside for a second, Harry, and I did have an opportunity to see a part of an interview from the CEO of the company, a small company that has this drug, and the reasons that they increased. And it was, I guess my takeaway was, it was a private equity company that owned or bought it and paid a fair amount of money for the company, and their costs are now higher.
Well, I did a little quick math, Chuck. It's a 5,000% increase.
It's huge. So,
5,000%.
But I think, Harry, we've always talked about momentum stocks, and biotechnology. You need to put those companies as a whole into the momentum world, and when you have a situation that we just witnessed yesterday, and the piling on, so to speak, and of someone that wants to become president makes a statement, that part of the market is ripe, to get through a very, very quick, violent corrective stage. It happens.
But how does one comment of one actor affect an entire sector? That just doesn't seem. That seems disproportionate to reality.
In a traditional world, it wouldn't. But because those stocks are considered momentum driven, it's like everybody gets in the left lane and they travel together, and everybody gets in the right lane and they travel together. So I think that's what happened yesterday. I mean,
you think about it. A sector was minding its own business, and all of a sudden, because one actor decided they were going to raise the price of a pill 5,000% from $13.50 to $750 per pill. And I don't know how often you have to take this, if it's more than one dose in a day, and how long you take it for. But that's a really incredible thing. And then it affected everybody, Chuck, in biotech.
It did.
That's wild to me.
It does happen, Harry.
It's like unfair.
You think about it with the markets. What they typically do is they sell first and they ask questions later, and that's what I think yesterday. That was what you saw was a result of that.
That's why he's the best in the business. Chuck Malamut, the official financial advisor to the Early in the Morning program. We're in our 25th year together here at WPG Talk Radio 1450. We're at 30 minutes past the hour. Again, to reach Chuck and the Malamut Group at Morgan Stanley's Northfield office for all of your financial planning needs, turn to the man that I turn to. The man has perfected his concept of total asset management coupled with that all-important asset allocation. He is Chuck Malamut, 609-383-2010, 609-383-2010. A quick Town Square News Network update. I'm going to talk about the man, the Chen man, and then we'll be right back. Don't go away. We're back 33 minutes past the hour. This portion of our program also brought to us by my good friend, Dr. Alan Chenman. Dr. Chenman is the official dentist to me, my family, to the Early in the Morning program. He is cosmetic and restorative dentist, Dr. Alan Chenman. His practice is the Smile Center of Linwood, and he literally perfects the art of beautiful smiles. Dr. Chenman does the full scope of general cosmetic and implant dentistry at his practice: porcelain veneers, dental implants I mentioned, crowns, bridges, inlays, onlays. Dr. Chenman can literally correct the wide variety of the so-called permanent cosmetic dental problems. You can have your smile redesigned completely at the Smile Center of Linwood. The proof is at smilecenternj.com. Click on the Smile Gallery, and you will see incredible photos of actual before and after cases. Dr. Chenman is located at 1999 New Road, Suite D in Linwood. I will be there later this week. I was just telling Chuck off air I'm going to be there a little bit later in the week. 609-601-2199. 9.5 out of 10 times you'll get Shannon. And Shannon is Dr. Chenman's outstanding appointment coordinator. She does a great job, and that's the first step towards a beautiful, healthy smile is to schedule an appointment. 609-601-2199. General and cosmetic dentistry. Dr. Alan Chenman, perfecting the art of beautiful smiles. Chuck, time is yours.
So Harry, we're going to continue this discussion with respect to the Fed and what they did and why they did it. So, as we look towards the end of the year, we've had what I think the best way to describe it is deteriorating credit conditions, and that could remain somewhat of a headwind for equities. Credit spreads, when we had the most recent decline in the market, they have widened somewhat over the past 3 months for a number of reasons. One, fundamentals are weakening. Fair amount of deflationary pressures from emerging markets because, the emerging markets, as we talked about, just got absolutely slammed. And concerns, again, about the Fed tightening. So if credit markets do not improve in the coming months, the rallies that we want to have happen in the equity markets might be somewhat difficult to maintain.
Is there any sign, Chuck, that, for example, if you apply for a credit card and you have worthy credit and appropriate debt to equity ratio, that you will receive a decent credit line, right? It's still, the spigot is still running.
It is. I mean, it's certainly not.
Remember back when we had the crunch, they were reducing people's credit limits. People maybe that were never late on anything had their credit card limits reduced. Some people had their accounts closed, and then you could pay off your balance. That's doing nothing wrong. Then it opened back up rather robustly.
It did, and what you're seeing, I don't think you're going to get that side of the market is not going to be impacted somewhat. It's more, if the credit conditions do deteriorate, then that's obviously a negative for equities. So, and the other thing, Harry, we just sort of touched on volatility. We think it's going to persist to a certain degree, but if you take a look at where we were back in that last week of August, the markets have been somewhat calming of late, and you're going to say, Chuck, wait a minute. The market was up 150 yesterday. You're down 230 today. You were down, big triple digits on Friday. How can you say that the volatility or the markets have been calming? The markets are showing some signs of stability, and the trading as we know it now seems to be somewhat more normalized as we have been accustomed to, and prices from that low that we put in on August 24th, they have moved somewhat higher. But if you ask the average investor and you ask a lot of institutional money managers, the sentiment, as we know it, is still somewhat depressed.
Countries that are trying, their little engine they have characteristics of a developed nation, but they're not really there. They're trying. They are in a position to right now be hurt. They could be. Yeah, it's a possibility. But we're going to see some additional volatility in the markets in the short term. But we do think, and we're starting to see the conditions are somewhat improving. So. And again, it all kind of circles back to the Fed. I mean, the policy that they have in place has been a topic that's been debated for the year. That's all we have talked about. What's the industry basically concluding? Did the Fed make a mistake, or it's just this is what they did, and you just go on and you deal with it? I think it's generally accepted that the Fed didn't handle the last meeting very well. That's my feeling.
Some of the Fed, in addition to the Fed chairman, some of the Fed members were interviewed, and there were a few that have come out and said, look, they were not in favor of this, and they wanted, we wanted to get on with this, and Harry, you don't know what the market would have done because the rate increase did not happen.
So in other words, it could have even gone down more, but I don't think it would have, though. I think the markets were waiting for that to happen and would have reacted okay to it. I'm not saying they would have gone crazy, high because of it, but I think that the markets went down that day because the markets were disappointed at the fake out from the Fed.
And what happens is, so now, with the Fed on hold, investors, certainly are confused and they're nervous about what the policy that is in place means for the markets and the economy. Small measured rate increases, as we talked about before, probably would be a non-event.
What do you say to your listeners, and many of them are clients and many of them are prospective clients, because you've talked about for 25 years, not going second to second, day to day, going crazy over every little hiccup that happens. But when there is volatility, it's hard. We're human beings.
We are.
Human nature. It's hard not to pay attention to volatility.
And I had this discussion with a number of clients last week, and then I said, I basically said, look, hold on for a second, and went back to the plan that that we had discussed of late, and I said, look, I'm looking at your plan right now, and I'm looking at the asset levels of what you have in your various accounts, and they are, up or down, slightly moved, but nothing significantly. So if you have a 90% probability of success of getting to your goals, because that's how we measure it now, and if your accounts, took a 3%, 4% hit, so to speak, your probability of success might go down a point or two.
Interesting.
You have to, when you have situations like this, not that we, and technology is a wonderful thing, but I'll tell you what happens with technology, a lot of us make some really, really poor decisions because we are just loaded with information. It just comes across so fast.
Almost too much.
And I remember, and Harry, I'm going to date myself now, back in, the 1987, the world was different. And look, the world is different in 2015. It's going to be different in 2025. There's no doubt about it. But I think the fundamentals of what your average investor looks for is probably going to remain somewhat the same over the next, 5, 10, 15 years.
But for the typical person, Chuck, that's doing business with you, that has the proper asset allocation and all of that, And if their plan is that this is for retirement and they're decades away from retirement maybe, or 10 years away from retirement, or it's for college building and the child's 3, you shouldn't necessarily be sweating what happened last week with Janet Yellen and the Fed when you're in something for the long haul. Is that a fair comment?
No, that's very fair, Harry, because, as you think about this, now we're focused on the Fed and what the Fed did not do and when the next Fed meeting is. We focused on, obviously, what's happening, in the various parts of the world. We're going to focus in the next 2 weeks about third quarter earnings.
Sure.
I'm starting to see, all companies don't report at the same time. I saw one miss and I saw one beat this morning.
It's almost where we've been, isn't it? Where it's a hit, it's a miss, it's a hit, it's a miss.
But here's what
hit
happens.
Hit the top line, miss the bottom line.
The point I'm trying to make is that, we're always going to be inundated with information. And it's a matter of how you handle that information and when you need to step aside and when you need to go in.
Has the role of the media become problematic for our markets? And I'm bringing that up as a member of the media because the way every second these talk heads, they never stop. They never shut up. And so they're always obsessing and micro-analyzing. And like I can imagine, this Volkswagen thing, I mean, they got crushed on the first day of that news. Crushed.
And they'll continue.
Yes.
They'll continue. I think
the media, I guess what I'm saying, Chuck, is the media has a big impact on our markets, don't they?
It does. And what happens is when you realize, and again, that what they're trying to do is capture your eyeball to the next commercial, then it all starts to make sense. That's not to say that you need to bury your head in the sand and just go away, but if you let's take last week for a minute, okay?
If you didn't go crazy for the first 2 days, by the end of the week, you could have gone to Disney World and nothing would have happened. You'd have been where you were.
If you left on Sunday and came back on the following Sunday, the equity markets were virtually unchanged.
So what do you say to people in terms? And I know there could be extraordinary occasions where you cannot help but to pay attention. But how often should people be looking at their numbers?
In a perfect world,
like when they get the statement.
Look, if you were a really patient investor, we would say, look, wait till you get your monthly statement. Unfortunately, with technology, a lot of us have a tendency to lose patience. So look once a week. Make it a point to look over the weekend.
Because if you need to do something, then you can address it.
Well, not so much that. I mean, the markets are closed, and so you have an opportunity to digest the information and maybe, in retrospect, take a look at what happened and why it happened. But the problem that we have, as you just talked about a few minutes ago, is that just so much information so quickly, and a lot of us out there are not capable of handling that information.
Agreed. Now, having said that, at the time of a big correction, or maybe even a period where a number of mini events are going on, is that a time to look at what you're doing and to see if anything needs to be looked at?
Well, absolutely. I mean, you have to continuously look at your asset allocation, and now what would probably happen is if you are rebalancing your account, you would end up selling some fixed income and buying equities at this point in time based on what the equity markets have done of late. We talked about the bottom that we put in on August 24th. Was this going to be a V-shaped type move? It typically never happens that way. You end up testing that bottom. So while we've had a rather tight trading range for the year, it's, as I mentioned before, investors, are nervous, cautious, anxious, and depressed as a result of what they're seeing. I mean, you think about, I think that you mentioned before we came on about the city of Chicago.
Yes.
Correct?
Yeah.
I mean,
hundreds of millions in new taxes.
You're going to, that's, you went through it in Detroit. We won't talk about Atlantic City, but the The school bonds were downgraded last week.
Yep.
As a result of the lack of revenue. So you're seeing that, in parts throughout the country. But I will tell you that there are parts of the country that are just on fire right now.
We're 9 days away from the end of the third quarter. About a month ago, I posed the notion. I didn't, predict it or anything, but I just asked the question. And I'll ask you again now, with basically just a tiny little bit of the third quarter and only the fourth quarter left in 2015. Is this going to be a lost year?
I think at the end of the day, Harry, obviously it's going to be a long way to get to the numbers that we, and along with others that we're projecting, were going to happen in 2015. I think this year is going to be one that's going to go. We marked time, and we virtually didn't get much accomplished.
We're going to tread water for a year.
I think that's probably going to be the end result. Now, I've seen and read a lot of analysts coming saying, no, we're going to have a great fourth quarter, and the markets will be positive. But we'll find that out, in the next couple of weeks for sure.
By the way, you never talk about any one stock, but once in a while you let me raise something, and we're on bonus time right now, 3 minutes overtime. Was Apple, because I haven't followed them, were they rewarded for the record sales of the iPhone 6s? Because I have to admit, I did not see record sales for that product because a lot of people like me were in contracts. We can get every 2 years a new phone. That's typically, iPhone is smart, and Apple is smart. They know when a whole lot of people basically are, going to be eligible. And so many people just bought the iPhone 6. But, Chuck, they set records with the iPhone 6S, and I didn't see that coming.
Well, they did, Harry, but, the stock, has held is in that, 113, 115 range. I'm not sure what the pre-indication is today. But
I wonder what the markets are going to think of their electric car.
They were not in favor of it.
I didn't think so.
No, I read some preliminary reports. And
they're out of their lane, no pun intended. They're out of their lane with this kind of thing.
Yeah, and I think my takeaway was they need to stay in their core business where they're successful, and this is obviously a venture that they probably should not be looking at.
And
this
Steve Jobs said, "Don't ever, ever, ever introduce a stylist pencil," and they did it, almost like they spit in his eye. Chuck, anything you want to share in closing?
No, Harry, I think we're good. As I said, third quarter starts relatively soon, and we'll see you again next week.
Look forward to it, Chuck. You've been listening to Chuck Malamut. He is the 25-year official financial advisor to the Hurley in the Morning program. Chuck leads the Malamut Group at Morgan Stanley's Northfield office. For all of your financial planning needs, give Chuck a call. Tell him I sent you. 609-383-2010. You will be absolutely impressed at his attention to detail, his team, their follow-up systems. They do a great job, and they understand total asset management with the all-important coupling it with the proper asset allocation. 609-383-2010. My words, not his, but I really believe where Chuck is concerned, he understands how you can prosper during the best of times and how to make sure that you don't get crushed during bad times. The following program that you have listened to is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. That's every Tuesday morning in the 8 o'clock hour. And Morgan Stanley Smith Barney, member SIPC. We'll be back in just a few minutes, a mini open forum segment, and we're going to be in wide open forum for the entire 9 o'clock hour at 609-407-1450.